Yes, this is Byron. I want to talk about options trading. I get a lot of questions about options trading. Okay, I'm just going to show you the basics because a lot of people want to get into investing their money, but not in day trading. They want to invest in options as well. Okay, let's talk about options. Say a stock is probably at, I'm just giving you some examples, $32 a share. I'm going to give you some examples. Now, on options, you'll see a format. Say the strike, they got different strike prices. Different prices you want that stock to get to. Say the strike price is at 36, but it's a time frame. You want it to get to 36 in 30 days, and they're gonna charge you maybe like 70 cents or something like that per share. A strike price, one contract is 100 shares. Okay, one contract is 100 shares. Okay, you want that strike price to get to 36. It's probably at 32 right now. This says at 32, trading at $32 a share. Okay, once that stock get to 36, it goes up to 36. Calls, you want the stock to go up. Is at 32, calls, you always want the stock to go up. Say it goes up to 36. Okay, you still haven't made any money because they charge you 70 cents per, 70 cents. They already charge you 70 cents, per 100 shares, one contract. Okay, so you didn't make any money. But say it goes to 37, you only made 30 cents per share because you lost 70 cents per share. See what I'm saying? But if you go up to 38 or up, you make some serious money. It's very easy. Okay, calls. That's how it works. But within 30 days, the contract is up in 30 days. So that's one thing you got to remember. The longer, say you want to keep it for 7 months instead of 1 month. The longer you want to keep the stock, the higher the price is. So it won't be 70 cents per share. It might be like $4 or $5. See what I'm saying? It gets very confusing. Okay, trying to make sure I ain't miss nothing. It's a lot of things. This is about calls. Calls, you always want the stock to go up. Always. Okay, let me erase some of this stuff. You gotta write this stuff down because options is very confusing. Like I said, with options, you have to the longer the term, say instead of 1 month, you want to keep it for 7 months. Probably the more expensive is going to be. Say that's part of calls inputs. Remember, calls is you want the stock to go up. You want the inputs. You want the price to go down. I'm saying like that, not the stock, the price to go down on puts. Calls, you want the price to go up. Puts, you want the price to go down. Okay, remember one contract when it comes to options is 100 shares. You need to write this down. One contract. So some people get 5 contracts. That's 500 shares. One contract is 100 shares. You need to write that down. Okay, like I said, with calls, and remember, you can figure out puts as soon as I show you about calls. Calls, like I said, say the stock is trading at $32. Okay, and you want the strike price, the one contract. You want to buy it in 30 days. It's a time period on all of these. You want to buy it in 30 days. You want to buy it at 36. Actually, you're waiting for it to go up to $36. The price of the stock to go up to $36. You still didn't make any money because it costs money. Like you paid 70 cents for the contract, 70 cents per share for the contract. Okay, the contract consists of 30 days. It's different amount of times. You can get it for 15 days, 30 days, 4 months, 7 months. It don't matter. I'm just using 30 days as an example. Okay, say it's the stock is trading at 32. You got you buy the contract. The strike price is at 36. Say it goes up to 37, and they charge you 70 cents to get that particular contract. That's 70 cents per share on that contract. Okay, now you made the strike price is at 36. It went up to 37. Okay, but remember, you still paid that 70 cents. You only made 30 cents a share. That's it, because you lose that 70 cents. But if it goes up higher, and it's not 30 days, it goes up to 39, 40, 41, 42, 43, 44. If you keep on going up, the most you can lose after that 36 is that 70 cents per share. You gain everything else. To me, it's a very delicate and dangerous thing, the options, because you got to know what you're doing. You got to, with calls, you have to expect the stock to go up. If it goes down, you might as well throw away the contract, because think about it. The strike price is at $36 a share. say it goes down, it's trading at 32, it never leaves 32, it stays at 32. You might as well void that contract because the contract is over with after 30 days, because after 30 days you have to do something. Okay, say it stays at 32. It never goes up to that strike price at 36. Get rid of the contract. The contract is gone. You don't make no money because excuse me. The stock is at 32. Your strike price is at 36. Why buy it at 36 when you can buy it at 32? So the contract is gone and you don't make no money, basically. That's what I'm saying. That's the dangerous part about a call. Okay? Remember, the longer you keep the contract, the more it's going to cost you. The longer you keep the contract, the more it's going to cost you. Okay? It's something else to remember, too. I'll make sure I got it right. I'll make sure I say it right. I want to explain this. Options is very tricky. I'm trying to explain and teach options, the basics of options to people. There's a lot more. It's called covered options. And remember, puts is the opposite of options. Okay, you are the, 1 second here. I'll make sure I say it right. With options, when it comes to calls, you are the seller and you sell into the buyer. It's like a handshake. You sell into somebody else. You selling that contract to somebody else. When it comes to puts, you are the buyer and you selling it to the seller. It's like the opposite. I hope I'm saying that right because that gets very confusing even to me. But that don't even matter. The amount of money you make and lose, that's all that matters to me. Okay. Like I said, the longer you keep the contract, the more it's going to cost you. Okay. Oh, this is important. This is very important. Oh yes, one more thing to remember. The higher the strike price, the cheaper the price is. Say if the stock is selling at 32, I'm using examples here. The stock is at 32. And instead of at the strike price you want at 36, say it goes up, you want the strike price at 40 instead of 36. Now it's harder to get to 40 than 36. The lower, remember I said at 70 cents they charge you? It'd be a lot cheaper. But I'm not a lot cheaper, but it'd be cheaper for you because you picked a higher strike price. Options are very confusing. Now, I hope you write some of this stuff down. Now, puts is the opposite. Say the strike price is at 36 and it's trading at 40 in the beginning. And the strike price is at 36. Remember, on puts, you want the stock to go down. Okay, and it goes down to 36 and they charge you 70 cents per share already. You lose money because you're losing that 70 cents. The strike price is trading at 40. The strike price is at 36 and it goes down to 36. You break even. You would think you break even, but no, you still lose that 70 cents. 70 cents times 100 shares. Because remember, one contract is 100 shares. So if you got five, I hate to say if you got five contracts, that's 70 times 500. You lose a lot more money. It's something you got to think about mathematically. So just say the strike price is at 36. It's trading at 40. The strike price is at 36. Say it goes down to 32. And after 30 days, say the contract ends 30 days because you don't have it for 7 months or 2 weeks. Just say 30 days as an example. You can sell. Remember, you can sell contracts at any time. Options contracts you can sell at any time. So say it goes down to 32. The strike price is at 36. It was at 40. The strike price is at 36. And go down to 32. You made a lot of money. You made a lot of money because you made an extra $4 per share because you got it at 36, but it went down to 32. That's $4 more. You made some money on that. If it goes down to 28, you made a lot more money. See, you want that stock to drop drastically when it comes to puts. Now, when it comes to calls, you want it to go up. Remember that. This is the basics of options. I need to write all this stuff down because you're going to forget it. You need to watch this tape 2 and 3 times. Now, I'm gonna talk about covered calls on my next video. Not my next video, but soon. I'm going to talk about futures trading. I'm going to talk about pennies trading, penny stocks. I'm going to talk about swing trades. I do all that stuff, but I don't do it that often. And by the way, I'm looking at my stock right now. Hold on. I'm looking at my stock that I guarantee that might go up Sunday or Monday because the Dow Jones.
Yes, options could be very complicated. If you're a beginning trader, I do not recommend it because, like covered options, I didn't go over that totally. That's on my next video. Um, I should be doing that in a couple of days. But puts and calls, you have to know the difference, and you have to know that you can sell. It's basically options is basically just a contract. You get a contract for 2 weeks or 3 months. It don't matter. I'm gonna show you exactly what it looks like on the screen so you can recognize it when you pull up your brokerage account, because that's very important. Options can be very tricky. I recommend it to the people that have been trading for a while, not the beginning traders, because so many people I know that do options or trying to do options, they lost thousands and thousands of dollars because the understanding of it is the most important thing when it comes to options trading, swing trading, all of them. Like I said, that's not my forte. My forte is, how do I say it? Short-term investing. I am the best in the world at that, and I'm making a lot of money for a lot of people. Very seriously, I'm being very serious right now. But I need you to like, subscribe, and share my video, and hit that bell button so when I make a training video like this, you can get it right away. Because I'm getting a lot of questions about options trading and things like that. But I want to show you what the format looks like when it comes to buying options trading. Okay, this is what the format looks like. This is I'm doing MU as an example because that's a great stock. You see where it got calls on one side and puts on the other side. Then underneath calls, you have bid and you have ask. And then you got the strike price right in the middle. The same thing with the put. You got the bid and the ask. So that's what you're going to be looking at when you decide to buy an options trade. Now, if you want the stock to go up, remember, you want to call. Call is when you want the stocks to go up. And puts is when you want the stock to go down. You have to remember that. And once you put in the bid or ask price, remember bid is what you want to sell the stock at, and ask is what you want to buy the stock at. So when you put the ask price, if you want the stock to go up to a call, then you put that 1915 or something like that. Okay? And you're trying to get the price, say, to 400, or you want the stock, you say where you want the price to get to, the strike price, where you want the stock to get to, and what period of time. At the top, if you notice, it says January 30th. You wanted to get to a certain price on January 30th. Now you could change that. I'm gonna change it for you. You could change it to, let's go to, we messed up here. Okay, I went to February 6th, so you could change it to, if you want the stock to get to a certain price on February 6th. See the bid and price change, the bid and ask change? It changes. So the longer you have the stock, the price will change. If you want the stock to get there 3 months from now, it's going to be a totally different price for the bid and ask. But this is basically the basic format of what you're going to be looking for when it comes to options trading. So those are some of the basics of options trading. I get a lot of questions about that. But today is January 27th, 2026. I want to look at my stocks. I recommend, I got it on a sheet of paper. I recommended CSCO, RCL, AMD, and MU yesterday on January 26th. Let's see how these stocks are doing because I am the best in the world. And before I show you what they're doing, the stock market just closed. I'm in Chicago. It's Central Time. It's 3:15, so the stock market been closed for 15 minutes. I need you guys to take a good look at yourself if you're not making money in the stock market. Say you're going with some big companies because they have so much convenience for you because you can't research a stock. And that's why you're with that stock company. Or they're offering so many things. But guess what they're not doing for you? They're not making money for you. If you're in that situation, definitely hit that bell button on my videos because I am 44 out of 45 towards getting stocks right before today started. I think today my stocks went up again. Now, remember my 3 rules, of course. Don't get greedy, buy low, sell high, and timing is everything. Remember those 3 rules and you will make money. But I'm a short-term investor. Some people do long-term. If you do long-term, that's fine. That's not my field, but I know how to do it. If you do swing trading, that's fine. But that's not my field. That's not my forte. If you do cryptocurrency, if you do options, all that stuff, I do not do those things, but I know how to do those things. But what I do is I make money for people that want short-term investing, the get rich quick type of investing. That's what I do. That's why a lot of people go with me because they make a lot of money off of what I tell them to do when it comes to the stock market. And that's what I want you to do by hitting that bell, like, subscribing, and sharing my video. And don't be selfish. Share my video with everyone that you know. But I want to see how my stocks are doing today. Remember CSCO, RCL, AMD, and MU. Those 4 stocks, let's take a look at them. See, stocks go up and down. Look at MU. Look at MU. Up 21.15. It was down 10 points yesterday, and a lot of people panic. They don't have an understanding of the stock market. All stocks, even MU, goes up and down. It went up 26 points on Friday. It went down 10 points Monday. And I said, do not panic. Please do not panic. I understand the stock market. You don't. If it's not negative news on that stock will go back up. And guess what? Look at it. I'm not going to say nothing. Look at it. It's up 21.15. And look at CSCO. I lost my breath there. Cisco Systems. I said that stock will go up. Look at it. It's trading at $78 per share. It's up 1.67. I told everyone that. RCL went down a little bit, but it went up 8 points yesterday. Stocks go up and down. It probably go up tomorrow unless negative news come out on it. And AMD of 72 cents. It's on the way back. So I just want to emphasize, I am right. Like now I'm right at like 48 out of 49 towards getting stocks right. I had to stand up. All my stocks went up, and the Dow Jones, I want to show you one more thing before I get off this video. One more. At the top of your screen, the Dow Jones is down 408 points. The NASDAQ is up 215 points. But the reason I'm showing you that is, look at the Dow Jones, down 408 points. I'm going to go back to me. You don't know what I just did. I picked 4 stocks that was going to go up. Now, when the Dow Jones go down, usually it takes all the stocks with it. Most of the time, not all the time, unless you got a real strong stock or unless you know what you're doing towards picking a stock. And that's what I did. I want you to watch that and see what I did. Please give me a chance to make money for you. I'm not going to talk your ear off, but please watch this video again and again and again and learn about options trading. If you don't understand it, watch it again. Give me your opinion and comments as well. Thank you. I love you and God bless you. I'll talk to you soon. Let's make some money from the Stock Master.